This is Jack from Clover Trading, and I want to talk about mistakes that beginners will make. As a trader for 7 years, I'm not even sure if I've made every single mistake in the book. I made a lot of them, but to say that I made every mistake, it seems a little arrogant just because there's always new things coming out and there's different circumstances and different stocks and anything can happen. Even in 2022, we've been seeing things that we've never even seen before. Without further ado, let's talk about some of these mistakes. To preface this isn't a one-size-fits-all conversation. Everybody is different. Everybody trades different styles, different setups, different risk amounts, but there are some emotional mistakes that are similar. So for example, not respecting risk levels. And up on my screen I have SMMT, which is a huge parabolic play right now for 3 days in a row. On day one, when it was gapping, it was up about 70% on the day, and it opened at 1.4 and it had a morning panic, and then it bounced into like the 1.3s, which I took a little bit short. Then it fell down, and I added a little bit here in the 1.2s. And that's not a great add because I'm shorting into support, which that's very not ideal because support is meant for buying and resistance is meant for selling. And when I wasn't looking, there was a 1 minute candle with over 3 million shares, and I think I was covering into like 1.5 or so. And that's okay. Even though I wasn't expecting that loss at all, or that fast, for a matter of fact. That's okay because I was risking the 1.44-ish area, and it went right past it, and I just stopped out. No big deal. Everybody loses on trades, and if there's somebody that claims they haven't lost, then they just haven't traded. So it's possible that you just haven't traded, and you're not really a trader if you've never lost. And in the past, a circumstance like this could really spiral out of control because now that I've taken a loss, I have emotions involved. And when emotions get involved, then I start to deter from my actual system of trading. And so for example, I would take a short like 1.42, 1.4, and I just keep shorting it down. Maybe it would go down here and I had more conviction at 1.3, and I would just start hammering more short, and then it would just squeeze up. It would spike up a little bit, and then I would say, oh, I didn't want that, I didn't expect that, and I would just start covering out and take even more paper cuts. And then I could actually do that all day until I just bled everything, because the market can be very pulling, and you have to be willing to just walk away. That's why you always have to respect your risk levels. If you don't respect your risk level and you don't get out, then you could find yourself in this huge squeeze, because later this day it went to 2.4 or so, 2.4, 2.8 in the after hours, and that's nearly a double from just these prices alone. Another mistake that I see a lot of people make is they'll use weird risk levels, and this would happen when I would be revenge trading and over trading on the day. So I would already be down more than I wanted to on the day, and I would make a trade like shorting here 1.47, saying I'm only going to risk like a few cents, keep the risk small, and it would work. And then it wouldn't work, and then I would be getting squeezed out for more than I planned to lose. And that's another thing that can just spiral out of control if you just keep doing mistakes like that. So that would be like an improper risk level. You should have like a wide enough risk on the chart where the stock won't breach it by just having its random walk. These risk levels should be triggered by a big wave of selling or a big wave of buying, not just random price movements like this, because if you zoom out, these all look very small. And why would you risk off something like this? It just doesn't make much sense if the stock can randomly breach your risk level. The next mistake that I want to talk about is having an uncomfortable risk amount. So this will mainly pertain to something like when you're trying to size up. A lot of people like to size up too quickly, and I always think it's a bad idea because that's the number one way to really blow out your account. You try to go much faster and much further than you were ready for. So if you have a normal $100 risk and you're good with that and you trade very cleanly, then the $100 risk is okay, but suddenly people will move their risk up exponentially. They'll say, I want to risk 1,000 because if I make 300 on this trade, that means I can make 3,000 if I risk 1,000, and that's just not always the case. You have to be willing to take these losses like in proportion to your account. And if you're just sizing up too fast and you're risking $1,000, it'll flash maybe 1,000, maybe even $1,200 or $1,300 loss, and you'll just panic out. So you have to make sure that your shares are smaller so that when these moves happen, you're not going to be completely scared. The next mistake that I want to talk about is trading random setups. So a setup should be very quantifiable. It should be something that you can log and know exactly what is going to happen and like what goes into the play to make it a perfect play. Because if you can't do that, then you're really just trading numbers on a screen that don't make much sense. And if you're doing that, then there's very good odds that you're actually in somebody else's like home field. And if you're playing in somebody else's territory, then that can be very bad for you because they'll have an edge over you. You only want to trade setups that you have the edge on, that you have the upper hand, that you know that you can make money with a cert or with a specified risk. Another mistake that is very common, and this one unfortunately has never truly gotten away from me. I'll always have a little bit of FOMO, and that's the fear of missing out. With FOMO, that's essentially like, you see SMMT, it begins squeezing up into the end of the day. You begin seeing it over here in like the 2.4s or here at 2.3, and then you'll say, okay, green candles, I'm just going to buy it. But then you get flushed out into like all this chop and stuff. And luckily this one came back and went to 2.7, but there's also a chance that it could just slowly fade off down to like 1.6, 1.7, maybe even 1.5. And then if you bought at 2.4, you're losing nearly a dollar a share on that. Percentage-wise, that's about 40% loss if you bought at 2.4 and you sell at 1.5. FOMO is the biggest factor in skewing your risk reward. If you're patient, you wait for these levels to come and you wait for a support to form, then you can minimize your risk, because if this breaks out, then you lose maybe 10, 15 cents a share, and then you get upside all the way up to 2.8. And another mistake is having too much conviction. There are times when you will feel like you're just winning every single play, everything you touch is money. It's like the Midas touch. When you have too much conviction, that's typically where you will begin to lose the most, because as soon as the stock starts going against you, you think that, no, I know what I'm doing, I know what this stock is going to do, you'll be proven wrong, and then you'll just wind up with a way bigger loss, all because you were too convicted. You always have to have that certain degree of uncertainty. You gotta be certain about the uncertainty. And if you can say that and manage your risk in it, then you're going to be good to go and you'll be safe. Trading is all about being safe and making sure that your account stays intact and that you're not going to lose everything. Because there will be scenarios where you just get so stubborn and you trade something like SMMT and you just fight it all day one day, then you come back the next day where it's gapping down, you think, okay, today's the day for the flush. So you begin shorting it, and then next thing you know, you're getting squeezed, and then if 2 days in a row wasn't enough, you get squeezed for a third day in a row. And that's why we always like to say stocks can go further than you think. The market can be irrational longer than you can be solvent. To end on a happy note, we've been seeing a lot of liquidity come into the market. There's so much volume. So for example, we had Tops last week that was trading 20 million shares, 40 million shares in a day. And it's good to see this volume come back, because for a while it's been pretty dry out there. And SMMT was trading 156, 100 million, 80 million in a day. And then there was a new runner today, which was PHVS, and this traded 80 million shares in a day. It's very exciting. I think that there's going to be a lot of momentum going forward, but every time you say that, it just happens to die out of nowhere. So we'll see, but this season is looking good. It's looking like a fun winter so far. Stay safe out there. Make sure to like and subscribe. Bye.